Hello, class. Jeremy Hooper here. Thank you for joining me for my Entrepreneurial Toolbox assignment for Dr. Davidson's ENT630 class of entrepreneurial growth, where I'm going to discuss chart of accounts and general ledgers. So, some of the things that we're going to discuss in my presentation is how we record and organize a business transaction as it comes into our business. Um, we're going to discuss how we begin to group and calculate those transactions so we can formulate a financial statement at the at the end of an accounting period. We're going to discuss how to utilize a chart of accounts, journal entry, and general ledger when we review those financial statements so we can have some level of conversation if we end up doing that ourselves, or if you're like me, I'm not an accountant. So I'm going to be working with one. And we want to be able to understand the financial statements on some level, have some sort of um, conversation about it. So just as a very basic flow, so once a transaction takes place and we receive possibly the invoice, we're going to utilize a chart of accounts. We'll get that in a second, and we're going to put that into a journal. So we can take a list of what we're spending. We're also going to list that transaction into a general ledger using the same chart of accounts, just a little bit differently. And that's going to give us all the information we need to begin to prepare financial statements such as a balance sheet, income statement, and so on. So, what are a chart of accounts? A chart of account is an index of all financial statements in the general ledger of a company. In short, it's an organizational tool that provides a digestible breakdown of all financial transactions that a company conducted during a specific accounting period. And it's broken down into subcategories past that. So a chart of accounts typically grouped as those subcategories and have assets, liabilities, equity, revenue, and expenses. So if we look here at our example of a chart of accounts, we see that we have assets under a category of 100. We see we have liabilities under a 200 category. There's our equity, there's our revenue, there's our costs and expenses. And this example also shows other income and other expenses. And I think that's a key point because our chart of accounts can be tailored to our business. It can really be something that allows us to just record the transactions. Our numbers. So numbers in this example are three. They also can be four numbers, five numbers. Basically, they're going to be the roadmap that tells us where they belong. So if we look, we see that assets are the 100 category. We see that cash is a subcategory there of 110, notes receivable 111, and so on. So, and then revenues, they all start with four. So sales will be 410, etc. And if we notice in this chart of accounts, they're not all in chronological order. So, the point there being is we want to have a very broad chart of accounts. We want to be able to, as our company grows, we want to be able to tailor those chart of accounts to be specific to our needs. So, if there in the future, as we grow, if there's a need to measure a certain transaction over and over again, and we want to break that transaction out, we can do so. So, just as an example here, if under assets, if we look at 117 prepaid insurance and 120 land, so we see that we have a couple spaces there, 118 and 119. So if we wanted to break out, a certain type of land or a certain type of insurance, and we wanted to start to measure that, or another type of asset, we've got a spot to include that here in our chart of accounts. So that's very important as we grow, and it's going to be very, very helpful. So just as we move on to a general ledger, the idea here is, or I'm sorry, general journal. The idea here is that a general journal records all business transactions in chronological order. So by date. The journal includes the account number from our chart of accounts, along with the account name and the transaction it's affecting. Most of the time, there's a description there also that's going to just say something we want to put in of why we purchased it, whether it belongs, that type of thing, just for future reference. The general journal utilizes double entry accounting where each transaction will affect two accounts. Always one is a debit and one is a credit. Again, I'm not an accountant, but I think for our understanding here, we just got to realize that when for one transaction gets listed twice. So if we look here in our example, we notice that each time we have an entry, it's listed for two accounts. So like the very bottom one there, we see that account 520, which is going to be our cost of goods sold, is also listed with a 130 account merchandise inventory. So it looks like here that we sold something for $10,000. So that $10,000 is going to be issued as a debit to that account. And then also our merchandise inventory accounts affected because we've lost some inventory or we've sold some inventory. So that is a credit of $10,000. And again, that's going to be very helpful as we move to a trial balance and we also move to a balance sheet. So again, we all understand that a balance sheet typically balances out at zero. So I'm not an accountant, but we need to understand that it's double entry. So as we move on to, special business, a small business, a journal entry here. So this is just another example of a small business, maybe a little extended. So they're not going to be as simple as our first example. So again, if you look here in this one where it states post reference, that's going to be our account number. And then again, you see how the double entry is accounted for, and we also can see where each account is listed. So like our cash account, we would have an equipment account, and so on. So now we get to the general ledger. And Investopedia states that a general ledger represents the record keeping system for a company's financial data with debit and credit accounts, records, and it provides a record for each financial transaction that takes place during the life of an operating company. So simply put, the general ledger is a recording process for all company transactions, and it organizes that information that will be needed to prepare for financial statements. It groups all transactions into accounts. That includes, again, assets, liabilities, equities, revenues, and expenses. Also utilizes the double accounting entry. So again here, almost like the journal, it's going to list all transactions, but if we notice here, they're going to be listed under the account. So if we cross the top, account 410 being sales, you see the transactions being listed there. Again, sales returns, sales discounts, all of our transactions are being listed if they're a debit or a credit, and it's going to be entered that way instead of chronologically. Some general ledgers also have T accounts, but again, I'm not going to go for the purpose of this conversation. I want to discuss it this way so we can make a point here. So again, we talked about the trial balance. And so at the end of accounting period, we're going to run a trial balance, and so we can just take a basic look. So again, all of our accounts are printed. You see their account number, and again, this is pre-balance sheet. All this is ran for is just so we can make sure everything equals out. So if we take a look there at our debits and our credits, they all equal. So that means that we're in balance, and most of our financial statements that we run going forward will be in line. So, an income statement, I wanted to use this one as an example as we talk about financial statements, just to kind of make a couple points on what we can take a look at, where we can utilize our chart of accounts, where we're going to utilize our journal entries, where we're going to also take a look at our general ledger, and where we can reference back on that once we have a statement. So when we're sitting down with an accountant, we're sitting down with somebody, and we identify something that we want to look into, we can reference back. And so I think working backwards is really the key here that I'm trying to bring forward to us all as entrepreneurs. So as I'm taking a look at this income statement, something that comes out to me, first off, I want an income statement that always measures against something. So there's a lot of income statements that are just going to tell us maybe a snapshot on where we are, but we're not going to measure against something. So this example here, we measure against our budget for the year. Some income statements are going to measure against year over year, so last year or a couple years behind. Some income statements are also going to show our account numbers. But for this example, something that sticks out to me first is our sales are down against our budget. So we budgeted $100,000 worth of sales. Our sales are actually to this date are 94,600. So we're falling short of our budget. So then when I look down at our expenses, one thing that pops out is our fuel. So our fuel is very heavy. It's about 17% high, or no, 72% higher than normal, and so that's a big deal. So now, out of just thinking about it, if our sales are down, but man, fuel's up, what is it? So are fuel prices up? So that's something to think about. Obviously, do we have more trucks on the road? What are we doing to drive our fuel up? But it's equating to less sales. So we want to know that answer. So this gives me the opportunity. So I will be able to go to our expenses category. I'll be able to go to our subcategory of fuel. I can go back and reference the journal. I can go back and reference the ledger, whichever one I'm more comfortable with. And then I can pull up that account and I can take a look for over this accounting period, all of our transactions that included fuel. So there I can get kind of a better snapshot, have an educated conversation with whoever I'm discussing with, whether it be my sales team, whether it be my operations team, whether it be an accountant. And I don't have to be an accountant myself to understand that. So this is really a tool that helps us as an entrepreneur identify things in our financial statements that we want to dig into again and work backward. So not too technical here from an accounting standpoint, but I hope I got that point across to you. Thanks for joining me tonight. I hope everybody is having a good evening, and thank you.